Good day, everyone, and happy Friday, and welcome to another episode of Financial Behavior. Here with newest advisor Jeffrey Campbell, and we will be discussing return distributions, things we're doing to portfolios to kind of help our investors. It's been great for us to be able to tell our investors we're only down, a half a point, depending upon their portfolio, 2.5 points versus the benchmark and versus what we're seeing in the news. So we thought we'd share a little bit about our strategies and things we do to help mitigate those risks for our clients. So we'll get right into the presentation, and we'll start with by just kind of talking about normal distributions and things of that nature in terms of how those work. So we're having a little bit of problem trying to get the screen to share, so give us a second here. Try to Chrome tab. Yeah, so we need to go to Chrome tab. There we go. So, all right. So Jeff's kind of going to lead this discussion on normal distribution, and we'll talk a little bit about. We'll try not to be too technical. Talk a little bit about standard deviation. You'll see that on the screen, and we'll kind of walk through that. So, Jeff, take it away.
Yeah, so happy Friday, everybody. I'm glad to kind of chat with everybody today. So what we have looking at is just a normal distribution curve where you have the fear on one side, the greed on one side, and then peak performance in the middle. And the slope is kind of showing that it's starting low performance in the fear section where people are scared, they're nervous about the performance of their portfolios, things aren't going well, higher risk as far as the standard deviation that we've seen before. And standard deviation simply is a measure of risk. And then as you're going up, we're looking at peak performance, and then we're getting into how that greed works, where you're trying to take advantage of the market in shorter times, and you're catching low performance off the back end of it. So that's how it works. Our philosophy when it comes to that, we like to cut off that left side, that riskier fear side, and just focus on keeping you closer to the mean without those big catastrophic low performance days, especially as we're seeing in today's market, is the biggest thing to kind of go off that.
Yeah. So to kind of piggyback on that, so what we're sharing is you kind of see here the dark blue area and the percentages. So 68% of the time, the returns are going to fall within one standard deviation of their risk, as Jeff is saying.
Mm-hmm.
And then we go out a little bit further, and you get into the light blue area, and then you go out a little further, and you get into the other area. So again, as a measure of risk, this tells us how to manage. So what we find with retail investors is they tend to follow momentum. Mm-hmm. And so they tend to follow this side of the curve. So when they hear on TV that Nvidia is hot,
exactly,
then they go buy Nvidia,
exactly,
or Bitcoin is hot, or whatever it is.
Mm-hmm.
So investors do a really good job on the momentum side and following momentum, but when things go left,
mm-hmm,
and we start to come down this side where we're losing money, risk management tends not to be their forte.
Exactly.
So from that standpoint, what we're trying to do is cut off, you'll hear in our jargon, cut off this left tail. Because this is what we call tail risk.
And that's where a lot of retail philosophers use that buy the dip.
Right, they
strategy.
Use that buy the dip strategy.
Mm-hmm. Which is hard to
time.
Exactly.
Yes, it's kind of hard to time. So what we found out is, since those are hard to time,
mm-hmm,
what's more manageable is managing your risk.
Exactly.
That's much more predictable because we have this data here. Mm-hmm. So we can predict what this risk looks like. If we can lower standard deviation and move out of these areas, we tend to keep your performance more so in the blue. Mm-hmm. So that's kind of in a nutshell the philosophy of cutting off that left tail. Now, by the same token, we're dealing with this environment,
exactly,
where people are scared.
Mm-hmm.
Now, what are some other things that people are doing that actually are also hindering their performance? What are some other products that they're kind of going to
Mm-hmm.
that are cutting off the right side as well? Because now they cap their performance by going into things like annuities
Exactly.
or some of your hybrid products where you've got we hear it a lot in the insurance side where people
Mm-hmm.
want to do an index VUL
Mm-hmm.
or index UL policy
Mm-hmm.
where they're just following the index.
Exactly.
But what they don't realize is they're cutting off some of this right side performance because when you go into that index, you don't get the capital gains.
Exactly.
You
It's
don't get
capped.
the
Mm-hmm.
dividends, but they've sold you it as an investment product to say, hey, but you can't lose. You know, you
Mm-hmm.
can't go negative. Okay, that's nice, but I can't get all the way over here either. So
Mm-hmm.
that's cutting off my performance as well. So when you start to kind of go into some of these things, you really have to understand what how that product operates. Um, so yeah, that's really important that we understand that. All right, so we need to pivot to another screen here, and let's go to our graphs here. And so we need to start actually on page 1. So Jeff, you can kind of outline for them the performance and where we've been. Well, as you all can probably see on the screen, we're pretty much up all across the board, beating benchmarks.
Exactly. And so all this chart is showing is our portfolios on the left, our aggressive, our moderate aggressive, and our moderate portfolios compared to the benchmarks.
Mm-hmm.
That's just using the market benchmark. So what the first YTD is just showing how our portfolios are performing. They're down a little bit, but that's just the case of the market at the time. And then when you're looking at the benchmark performance, is down a little bit more.
Right.
That's that passively managed portfolios that aren't, you're not managing the risk at all when it comes to it. And then that last column is just show how much we're outperforming, which is when you're talking in big portfolios, that 1%, that 2%, that 3% means a lot because that's real money that's coming out of your portfolio um, at the end of the day. So, yeah, that's the biggest thing. I mean, just from us, as we're talking about cutting off that left tail and managing that risk for each and every client, is showing that we can outperform those benchmarks pretty easily. And we've been doing it throughout the year. So,
Yeah, and absolutely. And actually, we didn't share, but this is important. These numbers you're seeing here are actually net of all management fees.
exactly.
So the portfolio managers that we use as well that are helping us put on these hedge strategies. As you can see, we've got for our clients who use the hedge strategies, they're really doing well. For instance, our moderate hedge is only down 0.69.
Mm-hmm.
So, and again, this is net of fees. So we're outperforming by 2.65%. That's huge.
Mm-hmm.
So let's go to page 2 and what that leads to in real dollars. So take it away, Jeff.
Yeah. So this chart by itself was based off a $1 million portfolio. So with that $1 million portfolio, we're looking at how much annual income we're getting from that from that portfolio, from our portfolio and the market benchmark. So the green is what a retail investor's market portfolio looks like compared to what our portfolio, the annual income from it, is in the purple. So not only are we outperforming that in percentage points, but it's also bringing more money into our clients' pockets at the end of the day. And that's what we're looking to do, especially when it comes to retirement planning and things like that. It makes so much of a difference being able to cut that left tail off because that's what turns into income at the end of the day. And that's what we're trying to convey with this chart.
Yeah, so if you kind of dive into those numbers, hopefully y'all can see them.
Mm-hmm.
But the aggressive portfolio, the retail investors' annual income is roughly 31,000. Versus again, when we've managed that risk over time and outperformed the benchmark, now that retail investors got $36,000 in retirement
Exactly.
annually. Moderate aggressive is going from 30,000 roughly to 38,000. The moderate portfolio is going from 29 or 30 to 35. So, you know, you're talking $5,000-6,000 a
That's a
year,
big difference.
that's a vacation.
Exactly. Exactly.
or something. So
down payment on a car.
in retirement, that's huge when we get to having a fixed income.
Exactly.
So yeah, that's huge. So all in all, guys, we wanted to share a little bit about the strategy, the philosophy, what has to be done. Of course, it's hard for a retail investor to do that because they don't have the tools that we have with hedge strategies and option strategies to overlay on top of a portfolio to really give them that outcome. So again, today's focus was to share with you all what we're doing over here at Fryar Financial to help our clients. It's just so great to call clients and they're just tickle pink with what's going on.
Exactly.
So we're gonna keep doing it. If we can help you all, please reach out to us. I'm available. Jeff's available. I'll be updating the website. So when you visit our schedule page, you'll see our pictures and be able to pick one or the other. Doesn't matter to us. We all the same house of cards.
Yeah.
We're both here to serve you and help you in any way we can. So feel free to reach out. Until next time, next podcast on financial behavior will be on. We're gonna get this one up pretty soon. We just touched on the indexed policies. So we got a good one coming up on permanent life insurance. Should it stay? Should it go? Until next time, we'll see y'all on financial behavior. Take care. Have a good weekend.